Hello, this is Greg Giardino,
And I'm Alison Hall.
and this is It's Your Smarter Money. And today we want to talk to you about reviewing your tax return. So for those of you who filed your taxes for 2024, we want to look at some important figures to see how you did. Did you get killed in taxes, and what can we do about 2025's tax returns? So let's dive into this. All right, so if you take a look at your 2024 tax return, a really important figure to look at is what's called your adjusted gross income, or your AGI for short. So you could find this on line 11 on your tax return. And what your adjusted gross income is essentially your total income or your gross income minus any adjustments. So what can an adjustment be? That can be if you contributed to a pre-tax 401k or a 403b, if you contributed to a health savings account, that can reduce your adjusted gross income. And if you're self-employed, you may be able to deduct health insurance premiums or self-employment taxes as well. So all in all, this is a really important number. We call this the line. And the reason why we call this the line is because this is really the starting line or the starting point from which your taxes are calculated. So all else being equal, the lower we can drive this number down, the lower your tax bill should be. And if your AGI is way too high, that's a problem because a lot of hidden taxes are keyed off of that number. So if your AGI is too high, you may end up paying more for your Medicare premiums once you turn age 65. Or you may wind up paying a higher capital gains tax rate as well on your dividends, interest, and even rentals and rental income and royalties. So keep an eye on this number. We want to make sure we drive it down as low as possible. Now, moving along, if you look at your tax return, if you look at line 12, you'll see what deduction you took for 2024. And you could take the higher of one of the two, either the itemized deductions that you have or the standard deduction. So most folks, they may take the standard deduction. For married filing jointly under the age of 65, that was about $29,200. But for those that itemize and have higher itemized deductions, you could take those. So for example, if you took a deduction for property taxes at the state and local level, you can do up to $10,000. If you have mortgage interest, that's deductible. If you're charitably inclined, those could be deductible as well. So it's really important you pay attention to this line and see maybe perhaps next year, and I don't want to steal Alison's thunder, maybe there could be an opportunity to itemize versus taking a standard deduction. And as you move along, really important figure here is your taxable income. This is line 15 on the tax return. So a lot of folks, they get this wrong. They think that, oh, well, my gross income is $300,000. That's the number that gets ran through those tax brackets, $19,000 worth at 10%, the next $40,000 at 12%. No, actually, it's your taxable income on line 15. That is what gets ran through those different tax brackets. And if you take your tax that you owed at the end of the year and you divide it into your taxable income on line 15, you'll find what we call your effective tax rate or your average tax rate that you paid. So if somebody was in the 24% federal marginal tax bracket, it's not uncommon that maybe they have a 17 or 18% effective tax rate. So keep these figures in mind. And moving into 2025, I'm going to swing things over to Alison so she could talk to you more about some tax saving opportunities.
So now that you have an understanding of the figures on your return, we're going to jump into some of the things that Greg just touched on. One of the first strategies is tied to charitable deductions, and it's called bunching. Let's say you donate $5,000 to charity every year, but you don't have a lot of other itemizable deductions. If you're taking the standard deduction, you're not getting any tax benefit for that donation. Instead, what you can do is consider making 3 years worth of donations or $15,000 at one time. By bunching them into 1 year, the itemized deduction now becomes more advantageous than the standard. For the next 2 years, you'd go back to the standard deduction and make the large contribution and itemize every third year. You're gifting your hard-earned money to charity to benefit a meaningful cause, but that doesn't mean you can't do it strategically and also financially benefit. Next consideration is, are you taking advantage of all your employer pre-tax benefits? In addition to 401ks and 403bs, which you should be maxing out if your cash flow can support it, are you taking advantage of everything your company has to offer? So deferred compensation plans, which shift ordinary income into a future year, ideally one where you have less income, or cafeteria plans, which allow you to make contributions for benefits on a pre-tax basis. For example, a flexible spending account or an HSA. Taking advantage of these plans will directly reduce your taxable income. Finally, check out your Schedule B. If you have taxable brokerage accounts with mutual funds and ETFs, or even a standard savings account, Schedule B is going to outline your dividend and interest income. Many investors and advisors will talk about asset allocation, which is which asset classes and investments should be in your portfolio, but most don't talk about asset location, which accounts should hold certain asset classes or investments for maximum tax efficiency. With taxable or non-retirement accounts, you pay tax on interest and dividends every year, even if it's set to reinvest. For this reason, you might want to hold growth assets in a taxable account. Typically, growth companies are putting profits back into the business as opposed to paying out dividends. Your fixed income holdings and bond funds, on the other hand, are paying interest, and it's considered ordinary income, so it's taxed at your marginal bracket, which could be as high as 37%. Making a conscious decision to hold these positions in tax-deferred accounts like 401ks and IRAs is going to eliminate that annual taxation from that income, which would be the case if it were in a taxable account. If this one feels a bit overwhelming, keep in mind that a qualified financial advisor should be able to help out with this.
So those are some great tax savings tips that you have there, Alison. And we really implore you, the take-home point today is review your tax return. And if you are unsure how to review it, please reach out to our team. We'd be really happy just to take you through the main important points of what you should be looking at. And hopefully you're off to a better tax planning start in 2025. Until next time, we'll see you soon. Take care.